Good morning and welcome to our webinar on PPP Tax Implications. This is Frank Balistrieri and I'm a partner at Sensible Sanfilippo. Over the past 6 months, we've done several webinars related to the PPP process. Given the time of year as we're getting close to the calendar year end and the fact that the forgiveness process is really drawn out far longer than most of us ever anticipated, we thought it would be a good idea to spend a little bit of time discussing some of the issues that we are seeing relative to taxes in the PPP program. I've assembled a great panel today to discuss what I believe are some of the biggest tax issues that you're going to be thinking about. So joining me today are Monique Ramirez and Tim Tchaikovsky from Sensible Sanfilippo, and Darlene Chang, an attorney from Hope Fenton here in the Bay Area. And all of us have really been spending quite a bit of time with clients advising them on all things PPP over the past several months. A few housekeeping notes for you as we get started. So we've got 90 minutes scheduled for today. We will make the recording available later today once it's available, so you'll get an email. This will also get posted to the Sensible Sanfilippo YouTube channel, so I would encourage you to go there as well if you haven't been there in the past. We've got quite a nice series of videos out there on a variety of topics. I have a few people working behind the scenes today that will be answering questions. I would encourage you to use the Q&A function within Zoom to submit your questions. We'll try and answer some of those live, and like I said, I've got people manning that. If we don't get to your questions live, we will also try to follow up with you later. We'll have a full download of all of the questions that we can go through, and I'll have your name attached to it as long as your name is there. When we send out the video later today, we'll also provide a link to a place where you could log in, put in your name and a question, and we can get back to you as well if you've got a specific question. Let's see, let's go to the next slide. Here's just a brief disclaimer. As with PPP, I think most of you know everything is as of the moment that we are actually talking to you. So bear in mind there could be further changes coming. That's just a little bit of a disclaimer there. Here's our agenda. I've been covering the overview, and I've got several discussion items that I wanted to cover today. Loan forgiveness and year-end tax planning, talk a little bit about financial reporting and payroll costs. There's some ideas that you might want to know about carryback provisions and some valuation implications just given where we're at in today's environment. And then we'll wrap up with some alternatives to PPP, some other things that are out there that you may be hearing about. Okay, so let's spend a minute and talk about loan forgiveness. So I think most of you are aware that the SBA opened their portal on April 10th, and it's been a very slow roll so far. Many of you probably haven't filed for forgiveness yet. If you have, it's been very, very slow. So in terms of deadlines, the banks have 60 days to respond to your application once you submit it to them, and then the SBA has 90 days on top of that to actually issue the forgiveness letter back to the banks. And right now what we're seeing is all banks don't have their portals open, and even for those that do have their portals open, it's not consistent across the board, which makes this a little bit difficult. So some banks are very tech savvy and have a full portal set up. Some are really just upload some documents and we'll figure it out from there. So it does make it a bit of a challenge to figure out what each bank is going to require. And then I've actually seen some banks go above and beyond what's actually required if you were to look at the instructions for the forms that are out there, which right now are the 3508S for loans under 50,000 and under, the 3508EZ if you meet certain requirements, or the full form 3508. We get a lot of questions around this. Is there going to be more stimulus and more PPP? We believe so, but we are dependent upon what happens in Washington in order to get to that point. So stay tuned. We will hopefully get through this presidential election in the next couple of days, and then that's going to go into litigation. So we'll have some clarity there at some point, and hopefully we can get Congress and the Senate back on this concept of PPP. What has come up over the last several weeks, and I'm seeing more and more of this, is M&A type transactions. Excuse me. Darlene, can you give us an update on what you're seeing on the M&A side and what some of the requirements are for companies?
Sure. Hi, good morning, everyone. Thanks for being with us this morning. So as an M&A attorney, currently I'm working on multiple transactions that I list 3 sellers, their PPP applicants. So the issue came up is that in their lending document, they all have a clause saying that if you have a change of control, then you will automatically enter into a default event. And the SBA specifically requires all the PPP borrower to get their consent, if they have a change of ownership or change of control. But they say, oh, we would give you 60 days to evaluate consent, but that's caused a lot of anxiety from both seller and the buyer side. So luckily, SBA issued a procedural notice last month, October 2nd, streamline the process. They provide some safe harbors, tell people like what circumstances we will give you an easy pass. You don't need to get our consent, but you only need to get the lender's consent. So they defined in that procedural notice, they defined what is considered a change of ownership for the purpose of the PPP. So if you have a stock sale, you sell at least 20% of common stock or other type of ownership, or you're selling at least 50% of your assets, or you merge to another entity, then that's called change of ownership under the PPP. So SBA provides that if you already paid off the PPP loan, or you complete your PPP forgiveness application, and the SBA already remits the balance to your lender, then you're okay. You don't need to notify your bank. You don't need to notify the SBA. You're fine. But the situation that if you're selling between 20% to 50% or below 50% of assets, then in this case, you just need to notify the bank. You do need to provide a copy of your purchase agreement, but that's it. But the tricky thing is that if you're selling above 50% and you're selling your asset above 50%, or you do a merger, then that came with the safe harbor procedure. So the SBA said, if you're following the situation, you don't need our approval, but you do need your lender's approval if you do the following things. One is that you already complete and submit your PPP forgiveness application. Second is you already use up all your PPP ballot proceeds. Third, you have to open an interest-bearing escrow account with your PPP lender. So you put the money with your bank, after your loan, your forgiveness application is approved, and the SBA remittance the funds back to the bank, then the bank will release the escrow money back to the current buyer. Obviously, if you have any repayment, you have to pay off any repayment to the bank. So that still came a lot of questions because, even with the safe harbor, there's still a lot of paperwork. You need to coordinate with both side counsel to fill them out and submit to the bank. I'll just give you a word of caution. I work with this bank on this one transaction, and we requested to have a conference call with the bank to go through the paperwork we submit them, and they come back to us, we still need to check with SBA. We need SBA's counsel to involve. So just give a word of caution. Even you think you qualify to the safe harbor, which I just mentioned, it will not immune from the involvement in SBA. So the best practice I would say, if you can wait the transaction, I would say wait until you have the loan forgiven or repaid, and then you don't need to get your bank or SBA involved. But if you're in the middle of a transaction, or you already have a LOI, letter of intent, and going to enter a transaction soon, then I would say engage your bank and get the process started as soon as possible.
Great, thanks. I did want to cover one more thing on here. So I mentioned that the SBA opened their portal on April 10th. I'm not confident at this point that they can actually accept a 3508S, which is the form for those that are applying for loans 50,000 and under. I think we're still a couple of weeks away from that. But other than that, the SBA is open and accepting applications. And then finally, on this slide, last week, Form 3509 and 3510 have been put out there for comment, but they're not technically issued right now. Those are the forms that you're going to need to start to complete if your loan is above $2 million. And I will tell you, I was not real enthused when I saw the type of questioning that was on there. So I would encourage you to just do a quick Google search for those if your loan's above $2 million and get those and take a look at them. My feeling is it's really more of a 2020 hindsight look on that, as opposed to looking back at what your requirements and issues were as of that date when you applied for the loan.
Yeah, and also for if your loan is above 2 million, the SBA specifically says you're subject to audit. So I always tell our client documentation. You want to have everything, keep everything for at least 6 years, and in case you get audited. Yeah.
So a couple of questions. Is the 50,000 limit likely to increase? I still have some hope that they're going to raise that to 150,000. That seems to have bipartisan support. So you may want to wait and not do anything. And then there was a question about, what do I do if my loan is between 50 and 2 million? You're really looking at either the 3508 EZ or the long form 3508. And I will tell you, if you can qualify for the EZ form, you definitely want to do that. So you need to talk to your advisors and understand whether or not you will qualify there. Financial reporting, this is becoming a big issue right now as we kind of roll into the year end. So if you look at the guidance that's out there relative to this, it's going to tell you one of two things. It's either going to be considered a loan, and there's specific requirements that you have to follow for that. Effectively, it says if you don't get a letter from the bank before your balance sheet date, it stays on the books as a loan. And even if you get that letter after your balance sheet date, but before you issue, this isn't something that you would adjust for. You would leave it there. Now, that doesn't bode well for companies that may have some loan covenant issues. So there is another alternative that's out there, and it really follows the international accounting standards. It's IAS 20, which would say that you could potentially consider this a government grant, and then you would estimate your forgiveness at year end. Now, I will tell you, the lion's share of companies will be looking at this as a loan. I think the government grant will be considered an exception. And there's still some issues with calling it a government grant, because in terms of that estimation process, for example, if your loan is above $2 million, we know that there's going to be some sort of audit or follow-up process relative to that. And so being able to make that assertion as to what that estimate is could get challenged if you're going through a year-end audit. So just want to make sure you're aware of those two issues, which is, may cause you to try to file for forgiveness sooner rather than later. But remember those two dates I gave you: 60 days for the bank to review it and 90 days for the SBA to look at it after that. Okay, let's talk about year-end tax planning. And Tim, let's bring you in on this one. So is this going to be a taxable transaction in 2020 or 2021? Share your thoughts with us, please.
Well, thanks, Frank. My name is Tim Tukalski. I'm a principal with Sensiva Sanfilippo, and I've been practicing CPA for 40 years now. I've just celebrated my 40th tax season. And yeah, the question really is, this is the overarching question. So of course, everybody's aware that Congress said that the forgiveness of the PPP loan should not be a taxable event. Under normal tax accounting rules, if I'm forgiven a loan, that is forgiveness of debt income, and Congress specifically said that that would not be the case. However, in a ruling that came out just within a month or two after the pandemic and this announcement, Treasury said that they were going to follow a rule which says that the deductibility of expenses that are paid with tax-exempt income will not be allowed. This came as quite a shock to us because, again, congressional intent was that it not be taxable, but to actually deny the deduction for expenditures paid with PPP money is tantamount to a taxable transaction. So let me just give you a simple example, and this is a conversation that's been repeating with my clients over the last couple of weeks. Client called me the other day and said that I have $150,000 sitting in the bank and I've got $150,000 of taxable income for the year so far. Can you help me with my tax planning? I said, sure. He said, so what kind of tax liability am I going to have on $150,000? I said, well, first of all, did you not get a PPP loan? He said, yes. I said, what was the amount of the PPP loan? He said it was $850,000. I said, well, what do you think your chances are of getting that loan forgiven by the end of this year? He said, well, it sounds pretty good. You know, the bank said that they're going to process the application. They're going to push it through. I said, well, if that's the case, then you can be expecting to pay tax on $1 million. You'll get your $150,000 of regular operating income, and then the $850,000 of PPP money that you use to pay expenses, which is included in your $150,000 income for the year, will need to be added back. So you will be paying tax on $1 million, which will roughly be $300,000 to $400,000, and you've got $150,000 sitting in the bank. Well, needless to say, my client was pretty upset about that, and I think that this will be an example that will be repeated thousands of times with thousands of constituents, hundreds of thousands of constituents across the country. So once we get through these little distractions like the election and the virus and the riots and everything else, I think Congress will wake up to the fact that we have a problem. We have a cash flow problem. And if you want a simple stimulus, which they keep batting around, simply make this deductible. Okay? That would be a simple fix. So I am confident, cautiously optimistic, let's say, that Congress will address this issue. But the problem is, what do we do with our clients today? So in spite of all the wonderful things that Frank said from a financial standpoint about forgiving the loans, and by the way, I mean, that would be the ultimate economic solution, right? That makes the most sense. If I can be forgiven that debt, by all means, get forgiven. However, if I've got to write a $400,000 check when I've only got $150,000 sitting in the bank, you might want to reconsider that decision. And quite honestly, this decision is probably going to be made for us anyway. I doubt very seriously that anybody is going to be forgiven between now and the end of the year if they submit their application. Frank, I think you said that the bank has 60 days to respond and the SBA has 90 days to grant the forgiveness. Well, we're already 2 months away from the year end. So it is likely that people will be not forgiven the loan and will be able to deduct the expenditures paid with it. And then of course the question is on the second bullet slide, well, it will be a 2020 event or a 2021 event. So I'm going to kick that over to Monique maybe and let her, give her thoughts on it.
Thanks, Tim. Yeah, this is Monique Ramirez, and I'm the tax partner in charge here at Sensiva Sanfilippo. So, this is, as Tim said, a conversation we're having repeatedly with our clients. And although we are optimistic that something will happen with the PPP forgiveness and that these expenses related to forgiveness will be deductible, we have to plan for the worst, right? And what's interesting about the timing of the deductions and the way that the IRS has laid out their position related to the forgiveness and the deductibility of these expenses is that they're not deductible if they relate to tax-exempt income. And what they're saying is that this forgiveness is tax-exempt income. So then it calls to question, what's the timing of these expenses? And when you look at it just on the face, these expenses were incurred in the 2020 tax year and relate to tax-exempt income, even though the timing of forgiveness may be happening in 2021. So at the face of it, and this is just an IRS notice that went out, and so in the hierarchy of the IRS's positions, this really is on the bottom, but at the same time, their position currently, as this is going to disallow deductions that really will be in a 2020 event. Without further clarification from the IRS, that's where we stand right now. There's multiple ways that this can get clarified. The most preferential way, obviously, is for Congress to take action on this. But if IRS continues to have clarifying positions, we may see the timing being addressed in further notices from them. So that's just something that we're looking at now. As it comes into whether or not we want this to be a 2020 event or a 2021 event, there's multiple factors that are coming into play here. And as we were talking about this earlier in the tax year, as we were batting this around in the summer and the IRS notice just got released, we thought, oh, let's wait still for forgiveness, because if there's any opportunity that this might be a non-deductible event in 2021, let's force it into 2021 if it's related to that forgiveness piece that happens in the 21 tax year. So it was a little bit of hedging our opportunities with our clients, making sure that we were positioned well enough to take the most advantage of this timing. Now, come election time, this causes a couple of other things and considerations we need to think about, because Biden's tax positions came out and he said that he was potentially going to be increasing tax rates on corporations from 21% to 28%, as well as to individuals. So anybody that has a flow through income, that also would impact them at a much higher tax rate if we were then going to allow these deductions into 21. Additionally, we have a secondary layer that we need to look at, and that was that the first round of stimulus, the CARES Act, came into play and allowed for provisions that gave us a net operating loss carrybacks again. So if you all recall, under the Tax Cuts and Jobs Act, Trump's tax reform, he did away with the ability to carry back NOLs. And I think I'm getting ahead of myself a little bit in these slides, but we'll get to that in a minute. But you'll see that the timing of when these expenses are coming into play has tremendous consequence when you look at the sheer tax benefit of $1 of expense. What's the timing that's really going to benefit you the most? And so we are looking at the potential tax rate changes, along with all the other provisions that has been released over the course of the last 4 years, really.
I think in addition to the timing issue, Monique alluded to the fact that we may actually have an allocation issue. So the IRS's position is that the treatment of the deductions or expenditures that are paid with tax-exempt income are not deductible, but they haven't given us any guidance as to how to make that allocation. I think there is some assumptions that to the extent that we are applying for loan forgiveness, and part of that application says we spent our PPP money on, let's say, payroll, which, as Frank will say, is probably the easiest way to get forgiveness. Well, is that going to be controlling for purposes of tax deductions? In other words, is the IRS going to say, you reported that you paid, you used all those proceeds for payroll, therefore all of your payroll that you paid is not deductible? And I believe the answer is no. I think those are two separate issues. One is getting forgiven such that you can prove that you use the money for a required purpose. And the second is what is deductible. And so let me give you an example. Out of the IRS has said that the basis for their ruling really rests with a code section that deals with the taxation of trusts. And in in a trust situation, if I have a portfolio of both taxable and non-taxable income, and I pay an investment management company to manage that portfolio, I am required to allocate or to actually determine which part of the investment expense is deductible by multiplying that by a fraction, the numerator of which is the taxable income, the denominator of which is total income. So in a very simple example, if I had $100,000 of investment income and 20,000 of that investment income was from municipal bonds, tax-exempt bonds, and I paid my investment advisor $10,000 to manage that portfolio. When I sit down and do the tax return for that trust, 20% of the $10,000 I paid to the investment manager, or $2,000, would be non-deductible. But notice it's only 2,000. Okay? If you were to use the example of, again, say it's PPP money, and rather than say it was 20,000 of tax-exempt municipal bond interest, it is 20,000 of a PPP loan. So using the IRS's logic, my ratio of tax-exempt income to non-tax-exempt income would be 20%. Well, that means only 2,000 of my investment interest deductions are non-deductible. So my point is, I believe that there needs to be some clarification as to how we allocate these costs. And we might be in a position where we can take a position that we can allocate these to our best position. I use the word position 3 times there in one sentence, but I think you get my point. So we are trying to plan in a time of uncertainty, and I think the watchword is going to be postpone forgiveness, extend your return, and hopefully by the time that your return is due, we'll have some guidance from the IRS or some rulings from Congress.
Yeah, that's great, Tim. And as I think all of you can see, we may have some conflicting priorities right now, right? Like there's a specific answer relative to taxes, but when you come back to financial reporting and needing to get like an audited financial out at year end, you can see there's some natural friction there, and the answers may change depending on both of those. And Tim kind of touched on payroll costs, and what we've been advising companies to do is take advantage of that 24-week covered period. And what we're seeing is even for companies that have an issue with full-time equivalents and perhaps even lowering wages, so a reduction in the hourly pay rate for a person or a reduction in their actual salary, you can overcome that by applying more payroll dollars to it. So as a quick example, say your loan is $500,000, and through the 8-week period, maybe you only spent $300,000. But if you extend it all the way to that 24-week period, maybe you've spent $900,000 and you've had a 10% reduction in your full-time equivalents. Well, by applying more payroll to that, you're going to overcome that full-time equivalent reduction, which is really going to get a lot of companies to full forgiveness. But there's one bit of caution there, which is what our tax folks have been talking about. Suppose you'd like to take advantage of something else under the tax rules, and the most obvious thing are the R&D tax credits. So Monique, can you speak to that real quick and perhaps a strategy relative to that?
Yeah, absolutely. And as Tim mentioned, it's still a big question as to how these expenses are going to get allocated to forgiveness. And so, we're dealing with very uncertain tax law, but again, we're trying to position ourselves to the best extent our clients can continue to take R&D credits, which are very closely linked to the deduction of payroll related to R&D and any other expenses, contractors that are involved in R&D. So those expenses, we don't want to risk those being disallowed, because there's a potential that the R&D credit will get limited based on the fact that the R&D costs, specifically payroll, would then get limited. But how much this is in our control, we can't say right now, except that we want to go back to documentation, as Darlene mentioned earlier, because, you know, to the extent that we can say these expenses would relate to other forgiveness items, maybe we have a position there to say we didn't really need to use R&D costs, payroll for forgiveness. We could have used our rent and other areas to actually get forgiveness. So we really don't think that they have any bearing to actually tie the costs that are used for forgiveness in your loan application to the tax code. Those are two very different things, but we just don't know for certain that they're going to go point to that loan application and potentially disallow. Again, going back to Tim's comment though, just based on the provisions they're pulling to say this is non-deductible, it likely is going to be an allocation method across the board and any expenses that would have qualified at the time. There is a couple questions coming through the chat too related to 501c3s. Because we're dealing with a very kind of patched together provisions on this. We're trying to read every provision of the code and apply that to this IRS notice. There has nothing specifically coming out about 501c3s and how this impacts them. But when we go back to this allocation of cost concept, you can see how if it relates maybe to UBI expenses, your unrelated business expenses, there could be a disallowance there that would trigger some taxable event. So it all goes back to how are these costs going to be allocated if they are not taxable? There's just no definitive answer, and there is a potential that it could impact nonprofits as well, which again, not the intent of Congress at all. So we're fingers crossed that this will continue to get resolved as we see the year progress.
Great, thanks, Monique. I see there's a couple of other questions I just want to nip that are in the Q&A as well. So banks should have notified you that there will be no payments due on this loan until 10 months from the end of your covered period. So you're not going to be making any payments probably until, you know, September or October of next year. So that gives you quite a bit of time until you actually have to really file for forgiveness. So I just want to make sure that's clear. And the SBA actually issued guidance that said the bank doesn't need to formally amend every note. If you could imagine what a mess that would have been if the banks had to go back and get you to re-sign. So many of you have probably received a notice from your bank that that is in fact happening. And if you haven't, you probably will be getting some of it soon. And then I just want to touch back on my example, because I see there's a question in there about FTEs and hiring back by year end. So if you can apply more payroll to this instance, you can in effect correct any FTE issues that you have. So it's worthwhile to run those calculations. And if you're using a third-party payroll service, they can most likely run the FTE reports for you. They've been a godsend in this whole process to really make it a lot simpler. If you can't run those on your own, you can get in touch with us. We'd be happy to help you with situations like that. And then just one last comment on this slide as it relates to payroll. So if you are trying to apply more payroll to your situation, but you still want to take advantage of the R&D tax credit, what I would suggest doing when you file your application is signify on there which payroll you're excluding. So for example, if you have a bunch of engineers that are going to qualify for the R&D tax credit, you can note on your application that you're specifically excluding that. And Monique, I think that will work then. They'll be able to take advantage of that R&D tax credit going forward. Let's talk about carryback provisions a little bit. You guys touched on this a little bit earlier, and Tim, you may want to pick this up. So I think of this as a way to potentially maximize cash flows. And I know for a lot of companies that may be looking at losses in 2020, what do I do? How do I deal with this? Can you touch on that a little bit, please?
Sure. So we are in a unique position, as Monique mentioned, with the TCGA, and I don't think it was part of the period, but anyway, the TCGA allowed for a 5-year carryback for 2019 and 2020, which means that not only can we carry back losses and get refunds at what potentially are higher marginal tax rates in those prior years, But there's also a unique opportunity to look at those years and determine whether or not we had maybe some deductions that we failed to take in those years. So what's interesting is, we're all familiar with what's called the statute of limitations with respect to tax returns. And normally that's a 3-year statute for federal, 4 years for state. Once I file that return, I am starting the clock, and I would not be able to change anything that happened after 3 years federal. However, there is a provision that allows for not only the IRS to re-examine a year that is closed if there is a carryback to it. That rule also exists for the taxpayer. So a case in point, we actually worked on a client who was entitled to, but had not taken significant R&D credits in prior years. And if we looked back beyond 3 years, they would not be able to file an amended return and claim those credits. However, because of the carryback to 5 years, that actually opened up our ability to do a study for 2014 and 2015, which normally would have been closed, and then carry that forward into a refund years. So, so I guess the advantage, again, this is not necessarily PPP loan related, but the point is, if you are in a position where you can create a net operating loss in 2019 or 20, or make that loss bigger, then you have the ability to carry that loss back and open up some years for refund.
Tim, I wanted to add to that.
Yeah.
Sorry. There are ways and strategies that we're looking at accelerating those NOLs that are potentially driving the 18, 19 years to carry back. Within the CARES Act, there were a number of provisions that unwound the Tax Cuts and Jobs Act limitations. So within the Tax Cuts and Jobs Act, they limited excess business losses. So if you had a business loss flowing through from your personal return, it was actually limited to a certain extent. There was, when the Tax Cuts and Jobs Act got launched, there was a technical glitch related to bonus depreciation, related to qualified improvement property. There was a number of things that kind of tightened up the rules for many businesses within the Tax Cuts and Jobs Act in trade-off for a favorable tax rate. Then the CARES Act came into play and undid some of those tight provisions. So it completely relieved the ability to take excess business losses. And actually, the mandate within the CARES Act, you have to amend the 18 and 19 tax years because this was a retroactive change that they did. So if you did have any sort of limitations that were triggered by the Tax Cuts and Jobs Act, it behooves you to go back and look at those years and see what now is being released and what can be amended, specifically maybe around bonus depreciation for qualified improvement property. And as you said, it gives us another opportunity to look into those years and amend with a cost segregation study or some other aspect. So you can see that there's a lot of different provisions all coming into play and intertwining into this window of 3 years from 2018 to 2020. And even as we're looking at projecting 21, which is a little bit more challenging, but you kind of can see that there's expenses and opportunities in any one of those years. And to the extent that we can get these expenses to be relieved in a 2018 year or 2019 year and drive a net operating loss, carrying it back to the 2013, 2014 tax year and even 2015 is really going to be beneficial. Now, I always find it interesting that the CARES Act, a big part of this, the budget that was put into the CARES Act was for the net operating losses, and we continue to see clients not taking advantage of that. So that is the big cash liquidity that we can get to get a carryback claim into years where corporations were subject to pretty high tax rate as well as individuals.
So another compelling reason to not get that PPP loan forgiven in 2020.
Right.
Right. We will have to deal with what the consequences are ultimately with the forgiveness, but I think a bird in the hand's worth two in the bush. You know, if you can't get out of paying taxes, at least defer paying taxes. This is this is a great way to do that. You know, the next bullet
Right.
point talks about some COVID related expenses, and I think also is related to the fourth bullet point. So clients have incurred not only losses, economic losses, just because of the pandemic, but they have incurred deductions and expenditures that are related to those costs. And there is under the code a provision, and this was not brought in by the CARES Act. This has been something that's been around for a long time, has to do with regular disasters. So clients have the ability, taxpayers have the ability to identify costs that were incurred during a federally declared disaster area and incurred as a result of the disaster. Those are, to be technical, that's under section 165I, and there is an election that can be made to take those costs or those losses back to the preceding tax year. So for example, let's say we have clients who paid attorney's fees to enforce the collection of rents on their properties because tenants couldn't pay. Well, that would be normally a deductible item in 2020, but because the president declared the entire US as a federally declared disaster area, and that expenditure incurred as a result of the disaster, that would be an eligible expense to carry back to 2019. Now you're saying, well, Tim, I already filed my 2019 return. Am I too late? No, actually, the provision allows you to amend your 2019 return and get a refund. And as we mentioned earlier, what if you amend 2019 to make the loss bigger? Then that 2019 return can carry back 5 years. So you can see the kind of pyramiding effect that this is going to have. But other things, I guess, that we would want to consider as far as COVID-related costs, PPE purchases, so protection equipment, masks, more sanitizers, barriers with respect to retail establishments or separating furniture and offices, losses incurred as a result of tearing out tenant improvements because tenants have now left. Now notice I said tearing them out. So one of the things that we cannot argue as a loss is simply a decrease in the fair market value of your business. A common question I get from clients is, well, my rent is lower because my clients couldn't pay me, so therefore that's a deduction. Well, no, it's not, but because you didn't get the income, at least you don't have to pay tax on it. However, there is a little quirky thing I want to mention. If you are an accrual basis taxpayer, and sometimes that could apply to real estate ventures as well, and your tenants are not paying or your customers are not paying, you cannot get a deduction for a bad debt reserve. You must in fact write that off. So again, there is a difference here between your book recognition. We'll get a reserve and get to reduce our accounting income by that. But for tax purposes, deductions, reserves are not allowed. Same thing would happen for inventory. If I had a reserve against my inventory, but I still hold the inventory, that's not going to be a deductible item. However, as a result of COVID, if I had to dispose of my inventory in 2020, write it off, say it was a perishable inventory for a restaurant operation, then that would clearly be a deduction in 2020, and it clearly would be eligible for a 165I deduction back to 2019. So some interesting plays here, lots of tax planning to be done as a result.
Hey, Tim and Monique, I saw a question in the chat around the other 7A loan program. So if an organization already had a loan through the SBA, they were offering a 6-month, basically the SBA would pick up the payment on that. Do you guys know if that is going to be a taxable transaction for a borrower?
I don't know. I would only be speculating. If it is related to loan forgiveness, I think the answer is clear that it would not be taxable. I'm not sure I understand the total transaction, but clearly Congress's intent was that any forgiveness would not be a taxable event.
Yeah, something that would need to be looked at closer and would be related to whether or not the IRS's notice relates specifically to PPP loan forgiveness. So, or, you know, the overarching question is whether or not Congress will make this change, and will it apply to all loan forgiveness? You know, there are people getting forgiveness for credit card debt and other items right now. So I could see them maybe allowing for some provisions around that. So I think it's still a big question.
Mm-hmm.
Yeah, there was one other question I was trying to answer in the chat too around an S corp where you've got husband and wife. So the example would be husband is technically the owner, but they're paying the wife a salary through the business. I don't know legally how you would treat husband and wife. Are they both owners, or is the husband only the owner? And can you talk about what could change that?
Well, are you saying that in context to getting permission? Well, under what context? So forgiveness?
Just simply from a forgiveness standpoint. So as an owner of an S corp, you'd be limited to $20,833 of forgiveness, and you'd have to file your tax return schedule to get that. So, but if you're an owner employee that's earning a salary out of a business, I don't know if you would be able to get the wife's portion included as forgiveness as well.
I don't know the answer to that. My suspicion is that if you actually paid the wife a reasonable salary, I think that would apply. Darlene, do you have any?
Yeah. So it comes to California, it's tricky because we're a community property state. You know, if you're not in a non-community state, then the answer will be simpler because, you know, there's no clear guidance from IRS or SBA on this specific issue, but general consensus that you treat the wife as a non-owner employee because her name is not on that ownership borrower certificate. So she should not be subject, she or he, you know, whoever is that non-owner employee should not be subject to those owner self-employee restrictions. But in California, you know, when you fill out the S corp election, you know, they treat the spouse has 50% interest in your ownership. So I will say, you know, if you want to take a conservative approach in California, you want to assume the wife may subject to this restriction, but you know, it's still up in the air. We waiting for more guidance. Yeah.
I did see somebody chatted in, Frank, and maybe this is a time to address it. I think it's an interesting question. I don't know that I have a definitive answer for it, but the question reads, our employees have incurred expenses setting up home offices to work from home. Can we reimburse them and call it a deductible expense rather than showing up as a payroll bonus that we have to pay tax on? Should we be giving them money to cover phone and internet expenses? So I think that there is certainly an opportunity here for arguing that these are COVID-related expenses. You know, we have the situation where if the employer actually requires employees to work from home as a condition of employment, and it is for the convenience of the employer, you must meet those two thresholds, then yes, I do believe that that is a deduction. However, I would caution you, and I think this is something that people are not paying attention to, is that you likely could have nexus in the state in which your employee is working from, if they work from home. So we are concerned, I think, as tax professionals that have clients who do business across state lines, that they may be creating a taxable nexus with the states in which their employees live. So be very, very careful. I don't know, Monique, do you have any other comments on that?
Yeah, Tim, that's a great point, because more and more we're seeing employees wanting to work from Idaho and other states that they have family, and this is becoming a more prevalent issue. There are state provisions that are allowing the relief of nexus for certain periods of time related to COVID. They are hit and miss though. So that's something that if you are triggering employees or have employees in a state, you will want to consult with your tax advisor, and we need to look at each state individually, because there were, as I said, there's provisions they're putting in place to allow for relief, but there also may be windows of time where it doesn't apply. It's nuanced in each state individually, but it is something to bring up to your advisors.
Great. So let's pivot now and talk a little bit about valuation implications, and this may involve some state issues as well. But in our current environment, we may be looking at assets that are now depressed. So, Tim, do you want to start with this, and maybe Darlene chime in on the estate side?
Well, sure. So a little disclaimer here. I'm not a valuation person, but I do spend a lot of my time in real estate investment analysis and working with appraisers. And my conversation with appraisers and valuation experts is that specifically with respect to real estate, what drives real estate values? Well, it's rents, it's net income. And if we are in an environment that rents are either being deferred or forgiven, that is going to have a direct effect on real estate valuations. Now, as far as the opportunities then that creates, we are looking at depressed values, maybe the transfer of real estate to family members, especially now. I understand that I think Proposition 19 passed, but 15 did not, if I'm got my news right. And the effective date for Proposition 19, to refresh your memory, so 19 was the one that takes away the ability for taxpayers, parents, to transfer their property to their kids, and their kids receive the property tax base that their parents had. So that has been eliminated, my understanding is, for transfers after February 15th of 2021. So I think we're going to see a lot of real estate transfers. But obviously the advantage of transferring property when values are low is that you're able to leverage your ability to make gifts during your life at a unified credit amount that is $11,580,000, I think, currently. And I'm sure Darlene will have some things to say about that. But we are doing a lot of estate planning for our clients, dealing with the transfers of real estate and the transfers of businesses, and taking advantage of the depressed value. Obviously, those values are going to be lower because of COVID, and also taking a discount with respect to fractional interests. Just a little caveat, we were in the middle of doing a rather extensive estate plan that involved a business for one of my clients, and they had received a PPP loan. So we basically had to put all of our planning on hold when we realized that this transfer would trigger a permission from the SBA in order for us to do the transfer, because it involved more than 20%. So as far as I know, Darlene, there is no exception for family transfers. You talked about the M&A rules. That applies across the board, even if you've got mom and dad transferring closely held stock to the kids. Did you have some comments on that?
I don't have much. So can you repeat your question? I was looking at one of the chat questions. So yeah, can you repeat your question?
Sorry, I was just saying that you had mentioned that in an M&A transaction, you need to get permission from the bank or the SBA if there's a PPP loan outstanding, if the transfer is more than 20%. And I'm not aware of any family transfers being exempted from that rule. That it would still apply, even though it's a family transfer, related party.
Yeah, there's no exemption or exceptions for interfamily, the wealth transfer exemption under the current notice. Maybe the SBA, get enough inquiry, they may issue another guideline to clarify that. But currently, just given the October 2nd notice, there's no such interfamily transfer transaction. Speaking about valuation, from the MA side, I talked to some broker and a banker involved in representing, the seller who has PPP, outstanding PPP. When they do the valuation, by the buyer, they typically separate the PPP and they offset the PPP money from their unused cash, balance. So that's how the PPP came into the valuation from the MA side. Yeah. I saw questions about the 5% ownership rule. So, whether it's the indirect or indirect ownership, the procedure, the guideline didn't specifically says direct or indirect, but we need to know the facts and circumstances about the ownership structure a bit more and to address that question. But the 5% is take a conservative approach is direct ownership. Yeah. So if you're a shareholder of an accounting firm or law firm, and that you own that 5%, you own less than 5%, then that exception rule applies to you.
Okay, great. Early on, we had some sound issues, Darlene, when you were talking about M&A. It looks like we're going to have a little bit of time to come back to that. So before we talk about alternatives to PPP, can you paraphrase what you talked about earlier on, and we'll all go on mute, so hopefully they can hear a little better.
So what I'm saying is that the safe harbor provided in the October 2nd notice is that if you have a stock, transaction above 50%, or you're selling at least 50% of your asset, or you have a merger, then before you have to get the SBA's consent. But SBA provides the safe harbor. They're saying that under this circumstances, you don't need to get the SBA consent, but you do need to get your banker's consent. If you have you submit your forgiveness application with your bank, and you use up all your PPP proceeds, and you put your PPP, the forgiveness amount, in a interest-bearing escrow account with your bank, with your lender. So once the transaction is closed and you finish the process, the money remittance to the SBA remittance, the forgiveness amount to your bank, to your lender, then the escrow money will be released to the buyer. So, if you do these three things, open escrow account, submit your forgiveness application, and use up all your PPP money, then you don't need to get the SBA consent if you're selling at least 50% of your company. Otherwise, you need to get the SBA approval.
One thing I want to add to that, Darlene, from some of the banks that I've been dealing with, the banks are still trying to figure out exactly how to make this work. So if you're in this situation, you need to make sure you talk to the bank and understand what their process is going to be. So just a word of caution there. And then can you touch on what happens to people that were in an M&A transaction or had a closed transaction before this guidance came out? What should they do?
I would say still get involved your bank because I know a lot of banks. I have one client. She has an asset transaction. She's selling 80% of her assets to another company. It's an architecture firm. And when she talked to the bank around in July or August about this transaction, her bank, contact didn't even raise the issue that if she needs a, consent from the bank. And only after us, we review the PPP document, we tell our client that you need to get the bank involved to get their written consent. And then the banker realized that they need to get the SBA guidance, So I would say don't rely on the bank, ask your attorney to review all your loan documents and then see if there's any triggering clause, to start a process to involve your bank. Even as I mentioned earlier, currently we have in the middle of a transaction and we already start the safe harbor procedure in the October 2nd notice. And the bank still didn't know what they need to do. And, they still need ask SBA's counsel to join our conference call to give further guidance. So I would say, just get your bank involved as soon as possible once you start the transaction, even, as soon as after you sign the the letter of intent, because the bank, they don't even have all the forms ready, and some of the form we receive actually is for the original PPP applicants. That when we send those documents to the buyer side, they got confused. They say, "Oh, we're not the applicant. Why you send us those forms?" But we say, we check with the bank, and they say, "Well, I'm sorry, we don't have any new forms for the buyer. We only have our existing forms, so you have to fill them out." So I would say, there's still a lot of unclarity, and although the October 2nd guidance, procedural guidance, helpful, but it's not, solve all the questions people have. Yeah.
Okay, great, thanks. And our last slide here that we were going to cover is really what we call our alternatives to PPP. So Darlene, can you take us through this slide, please?
Sure. So I will introduce some of the alternatives to PPP. So we have some clients that they are not eligible to receive PPP loans for a variety of reasons. The most common one I see is that they're a subsidiary of a large, so like a large company. So under the SBA affiliates rule, they are not eligible to apply PPP because they're not considered a small business anymore. So in this kind of circumstance, we often tell them to apply, to get the employee retention credits. So the employee retention, but if that's for people who don't have PPP. If you have PPP, you are not eligible, for the employee retention credits. So the CARES Act provides that, eligible employers will receive a refundable payroll tax credit for up to 50% of wages paid to employees after March 12th, 2020 through January 1st, 2021. So this is really provided for the 11th employer that you have people sitting around and then have no work for them to do, but you want to keep them on a payroll, but also you're not able to get a PPP loan. So this is a program for you to consider. So what is considered as eligible employer? The Act defines that an employer that is carrying on a trade or business in 2020 and for the calendar quarter, the operation of the business is fully or partially suspended due to orders from government authority limiting commerce, travel, or group meeting due to COVID-19, or gross receipts are less than 50% of the gross receipt for the same quarter in the previous year, until gross receipts are 80% of the gross receipt in the same quarter for the previous year. So again, there's no credit available if your employer, if you're a self-employee. So this is only eligible provided for your employee. If you're a self-employee employer, this yourself cannot claim for that credit. So the wages are limited to $10,000 per employee, and the maximum credit of $5,000, and it cannot exceed the amount of such employee would have been paid for the working and equivalent duration during the 30 days immediately preceding such period. Again, the SBA and the CARES Act provides that if you have employee less than 100, everybody can qualify can get that $5,000 basically. And there are a lot of talking about whether the 5,000, because currently that 5,000 is just limited to 1 year, so there's a lot of talking, hopefully, to see the new stimulus program can adjust the 5,000 per quarter, and so it would give people more relief. So that's, if you don't have a PPP and you want some cash to keep people on your payroll, this is a program for you to think about. The credit, you can claim it on your form 941. You can consult the accountants here to get the filing. So the next program is the Employment Social Security Deferred Programs. There's two programs under this deferred programs. So the employer portion deferral is codified in the CARES Act. It's so you can claim the 6.2% of the employer Social Security payroll tax to defer, and by paying 50% at end of 2021 and another 50% by 2022. But remember, this is a deferment, not credit. So you still have to pay. But if you're cash short, and you want to preserve cash in 2020, you may consider this program. And then there's no restriction for the deferred program. And, even you have PPP or you have the employee retention credit, you can still apply for this program. And the last one, the employee defer, that one is pretty interesting. It's not codified in CARES Act. It is just, responding to a president memorandum, and that's for the deferral of the employee portion of the Social Security payroll tax. And in October 28th, RS issued a notice 2020-65. It authorized it basically just give the direction of how the employer can claim that the tax deferral. So it's not mandatory. It's optional for the employer whether or not they want to provide this program to their employee. And the tricky thing for this program is that the deferral is only for September 1st to December 31st. And after that, that deferral, the liability needs to be back in the first quarter of 2021. So the issue comes up that if you have an employee leaves, your company, and before December 31st, 2020, and then he or she opt in to this deferral, employee payroll tax deferral program, then what, as an employer, what you should do, because he or she left, and you're still responsible to pay in the first quarter of 2021. So we often advise our clients that, in these circumstances, when they opt in, you should ask them to sign the agreement, to agree that they will pay you back, write you a check to cover the deferral, amount. But at this point, there's still a lot of unclarity about this program, the employee tax deferral program, and a lot of payroll provider still try to figure out how to do this logistically, whether they can process that. So our general advice to the clients that, since it's not mandatory, you're not obligated to provide to your employee, you should just stay out of it. And yeah.
Tim and Monique, I see a few questions in the chat around, hey, here's my specific situation, what do I do? And I've been trying to answer a couple of those with saying we really need a holistic picture of what your tax situation is, because I think people are focusing on, like, I've got a $200,000 loan. Do I apply for forgiveness in 20 or 21? And I think it's more prudent to say we would need to look at the whole picture. Like, do you anticipate a loss in 20? Did you have a loss in 19? Would you guys agree with that as a statement?
Absolutely. It's very nuanced depending on what your particular situation is. We'd have to go back and look at prior year tax returns. We really want to get a full picture because, as we mentioned earlier, there is a lot of overlapping provisions that could be beneficial to any taxpayer that we need to look at a little bit closer. One of the things we didn't mention earlier is that with the Tax Cuts and Jobs Act, for example, they allowed for more taxpayers to make an accounting method change from a cash basis to an accrual basis. So if you are a small taxpayer with an average $25 million or less of revenue, this might be an opportune time to do some of those things. So there is no black and white answer as to when you really want to get that loan forgiveness to come into your tax return. It really depends on your particular situation and which one of these levers you can pull to give you the most tax advantageous answer. So unfortunately, we don't have a black and white answer. The idea, though, is to make sure that you're having conversations with your advisor and strategizing with what's going on in your operations and your history of taxability.
Thanks, Monique. There's a question that I really want to nip in the bud because I think there's some incorrect information in it. So I said August 2020 was the date when the SBA opened their portal to accept applications from the bank. And let me be clear, they are taking applications from the bank, and we have seen clients get forgiveness. It's just a really, really slow process right now. And I don't know exactly what procedures the SBA is going through. I would hope that they would have some sort of automated system that's looking at this with some sort of algorithm to determine whether or not the loan needs further review, but they are accepting applications. The one caveat would be the 3508S, which is for loans under $50,000. I know one of the software providers that we work with has said they won't have that up and running until November 13th, so a week, basically next Friday. So just want to make sure I'm clear on that. And then there's a question around the EIDL as well. So when you fill out your application for forgiveness, you're going to have to put down whether or not you received an EIDL loan. And here's the interesting thing relative to that. So that's going to be anywhere from $1,000 to $10,000 on that advance is really what they want to understand. And now the bank is going to be required to effectively collect on that. So that portion of your EIDL loan is now going to follow, to the best of my knowledge, at this point, it'll follow the original payment terms of your PPP loan. So an EIDL loan technically had, I think, a 30-year payout, 30-year payment portion to it. But if you have that advance, it's going to be taken over the 2 years or the 5 years of your loan. And then,
Frank, can you hear me? Hi, Frank. I had I was watching the chat here and an interesting question popped up and I almost hesitate to to bring it up, but it does shine a bright light on the difference between accounting rules, financial accounting rules, and taxation. So the question, if I could summarize it, was they say that they're on a cash basis method of accounting, and they know that they're not going to be forgiven their loan by the end of this year, but they are concerned, I believe, about the financial reporting requirements as a result of that. And I would imagine, reading between the lines, this has to do with the deferred tax liability. So what would happen in a situation if someone was going to get forgiven? They're going to get forgiven in 2021, but they are taking deductions based on, him and Monique's recommendation, let's defer the forgiveness and take the deduction. Have you created a timing difference with respect to your tax provision?
Yeah, I think the answer to that, unfortunately, is probably yes, because this is where things start to get squirrely, and why the accountants and the tax providers need to be in lockstep. And really, one of the main reasons why we're having this discussion today is because we need to make sure that borrowers are talking with both sides of their accounting house, right? The tax accountants and the GAAP accountants need to be in agreement here. But that's why I still like the idea of calling this a loan, and then you don't take it off your books until 2021. It's neat, and it's very easy for me to explain, but that could run you into debt compliance covenants at year end. Now, you may have all your loans with the same bank, and that may help, but then you layer in the tax issues on top of it, and now we've got a deferred item, perhaps because we're taking deductions in different periods. So I just want to make sure we bring this up as an issue so that we can start the conversation and work towards resolution. And I think as of right now, the answer, unfortunately, is we just don't know, because we're still hopeful that some of the lobbying that's being done by the AICPA and by other groups is going to get to Congress and have them issue something, likely probably right up to 12/31, that may resolve this issue. Correct?
Well, let's hope so. Yeah, absolutely. Because it is going to cause nothing but problems. Even when you were talking, I was thinking, as far as, so clearly the deduction would be a timing difference, but the forgiveness itself would be a permanent difference on your tax provision. So that would make for an interesting effective rate. Yeah.
Yeah, clearly there's a ton of issues related to this. Do you guys see anything else in the chat that we should address? Any questions you want to try and cover live?
There was a question going back to COVID-related expenses around 165I. The idea behind that is that we need to make a direct link between the expenses that are being incurred and the current disaster. So I think the question related to additional employees that you had to hire to monitor the flow of clients coming in or customers coming in the door. Those expenses, I think there's a really strong case to treat that as a COVID-related expense. Now you have to be careful that you aren't just replacing another maybe employee that would do a similar function. So look at that closely. But again, we're asking all our clients to compile any of these potential related COVID expenses so that we can have the conversation as we're preparing the 2020 tax return and looking at whether or not this would be beneficial to carry back to the 2019 year. So it's deductible because it is an expense that you're incurring for your operations and your business. The whole idea of whether or not it's linked to COVID really goes back to whether it makes sense to take it in 2019 or 2020 and just opening the door for that opportunity. It's not really creating an additional deduction, but the timing might be more beneficial in one year over the other. So continue to compile those things as you think about something that might have been related. A lot of our clients in the food and beverage space had some, inventory write-offs Those are all things to really consider and put on a short list of expenses, or perhaps it's a quite long list that you're compiling since this started on March and to now. And you're going to continue to incur these expenses. As Tim said, this is really applying a very old provision within the code to the current disaster, and there's really no precedent to how this is treated. This disaster is not like any other disaster where it's a short window of time and you can easily isolate expenses incurred. So there really is no precedence or things to point to say this is exactly how this provision will be applied. We need to build a case for it and make sure that we actually have a good facts and circumstances behind taking the expense as a COVID-related disaster expense. So throw as much as you can on that list for conversation.
I think it's a good time to reiterate, though, that there is some confusion regarding whether or not this pandemic is a casualty. So there are provisions in the code that allow for casualty losses, both for businesses and for individuals, right? If you have a disaster, say if you lost a home, a personal residence in the Paradise Fire, well, that is potentially, and wasn't reimbursed by insurance, potentially that would be an individual deduction that you would get to take. Well, nobody has determined whether or not this pandemic is a casualty, and likely they are not going to, because a casualty has to be sudden and unexpected. And this has come on over, a length of time. And not only that, it would just open up a Pandora's box for the deductibility of things that have lost value. So again, when we're talking about COVID-related expenses qualifying for carryback to 2019, we're talking about deductions that were actually incurred or losses that were actually realized and recognized. You sold stock related to, I had an example where a client had their portfolio was actually collateralized by their line of credit was collateralized by their stock portfolio. And the bank made them liquidate their stock in order to pay back the portfolio pay back the line of credit when the value of the stock went down. Well, so my client incurred capital losses as a result of that, a direct link to the COVID-related expense. We took the position that loss was carried back, capital loss was carried back to 2019. Now, on the other side of the coin, if my business has gone down in value, or my real estate, right, has declined because my rents are down, well, if you still own the property, that's not a deduction. It would be under a casualty loss, but this is not a casualty. All right, so just get that clear in your head. At least not now, and I doubt it will be.
Darlene, I saw a question in there that talked about what happens if my PPP loan goes into default. Can you touch on that? I thought there were no recourse provisions on this, but maybe it might be a good thing to just mention from a legal perspective what would happen if your PPP loan goes into default.
Well, the first thing you need to see what's the loan document says, when you got into the default. But I think, it's you can still treat it as just a loan, and if it's, what do you mean it's become the default? Yeah, I think that we need more facts, in the circumstances of default, in order to address the issue, and the actions need to take after consider the default. Because the first step people will take is just to apply for the forgiveness, and if you're not, the loan is not forgiven, and then you're subject to payment, then you will, if you fail to make the payment, then you enter default. So we really need to review the loan document and see what's the I haven't work with any client that they're in a default situation, you know, and in the MA context, you know, the trigger is just the change of control, but usually the bank, you know, and it's not enforce that provision because it's subject to the SBA guidelines for, you know, for typically just give the consent and subject to the consent procedure. I talk about it. Yeah. I think we can talk about this offline, you know, to address the specific situation, the default event, and then I have a more intelligent answer for that.
Okay, great. And as we talked about, a lot of these questions that are coming through have some really specific elements to them, and it wouldn't be appropriate for us to just kind of give an off-the-cuff answer because we really need to understand the whole situation. So if it's more of a legal question, you know, Darlene's contact information, I'm going to put this up on the screen now. You'll have her information here. If it's a tax question, I would reach out to Monique or Tim directly. And if it's a financial accounting or loan forgiveness type of question, by all means, you can reach out to me. We are available to help. We will send out the information when we send the video. Our contact information will be in there as well. If you would like, please also make sure you visit the Sensible Sanfilippo YouTube channel. There's a lot of good content out there related to some of the previous SBA related webinars that we've done, plus a lot about other consulting items that the firm has to offer. Tim or Monique or Darlene, any final comments that you'd like to make?
I just chatted in one answer to a question. Somebody just mentioned, well, if we don't think we're going to get forgiven in 2021, or excuse me, 2020, why wouldn't we just go ahead and apply for forgiveness and let the loan be forgiven in 2021? I guess my answer to that is, well, you don't know that once you start the application process, you might actually get forgiven in 2020. I don't know, and I'm not aware of any way to stop that train once it goes down the track. So if you apply today, go through the process, and then they're ready to pull the trigger, and you say, oh no, wait a minute, don't forgive me. I don't know that you're going to have that flexibility, right, Frank?
Yeah, I think that's true, unfortunately. So as you can see, yet another conundrum with some of this.
Yeah, I'll just close by saying that timing is still a huge issue. And I know that that's probably the most pressing concern for everybody right now is when is this coming into taxable income? What do I do now? And especially if you have a fiscal year end, if you're a 630 year end filer, 930 year end filer, this is a really pressing concern, and it's understandable. We don't have answers yet. I think it's safe and conservative to assume those deductions are not deductible in that period for purposes of, you know, generating your extension payments, your estimated tax payments, with the idea that if it's not taxable now, it'll be taxable in the next year, and you'll have that overpayment flow through. We are still hoping for congressional change, as we mentioned. So if you want to take that conservative position and you have the cash flow now to make the payments related to the tax exempt position and deductibility of those expenses, it would make sense to have that. Now, I would not file your tax returns if you're on a fiscal year end. If there's any opportunity, extend those returns. Do file an extension payment to give yourself the opportunity to bring those expenses appropriately, or the non-deductibility of those expenses, into the right tax year. So leave your doors open. That's our position with our clients right now, as we mentioned earlier, is making sure that we're best positioned to take advantage of whichever way this ends up going. And definitely reach out if you have any questions. We're here to help and to strategize about how this might best be applied in your particular situation.
Okay, we are just a minute over, so I want to thank everyone for participating today. And like Monique said, if you have questions, please don't hesitate to reach out to us, and we will sign off. Thank you very much.